When the stock market crashes, panic sets in. News headlines scream, "Recession." Social media fills with fear, and portfolios suddenly start bleeding red. But here's the truth: bear markets are not the end of the world. In fact, they're one of the greatest opportunities for wealth creation, if you know how to navigate them correctly. Unfortunately, most investors do the exact opposite. They panic, make emotional decisions, and destroy years of hard work in just a few months. In today's video, we'll break down the top 5 mistakes investors make in bear markets, why they happen, and exactly how to avoid them, using lessons from history, psychology, and real-world market data. Stick around till the end, because mistake number 5 is the most common one even seasoned investors fall for. Before we dive into the mistakes, let's make sure we're on the same page. A bear market is when prices fall 20% or more from recent highs, often triggered by fear, inflation, rising interest rates, or global uncertainty. But here's what's fascinating. Since 1950, there have been about 15 bear markets in the S&P 500, and every single one was followed by a bull market. So the question isn't, will markets recover? The real question is, will you be ready when they do? Mistake 1, panic selling. This is by far the biggest mistake, panic selling. When the market tanks, it's human nature to want to cut your losses, but here's what most investors forget: losses only become real when you sell. Let's take an example. During the 2008 financial crisis, the S&P 500 fell nearly 50%, but by 2013, it had fully recovered, and by 2020, it had tripled from its lows. Those who stayed invested not only survived, they thrived, but those who sold during the panic locked in their losses and missed the entire rebound. Be fearful when others are greedy, and greedy when others are fearful. That's not just a cute quote, it's one of the most profitable principles in investing. Actionable advice. Don't sell emotionally, don't check your portfolio every day. Remember, market volatility is normal and temporary. Mistake 2, trying to time the market. Maybe if I sell now and buy back lower, I'll avoid the pain. Sound familiar? That's the illusion of market timing. Even professional fund managers struggle to do this. Data from Dalbar shows that the average investor underperforms the market by 3 to 6% per year, mostly due to poor timing decisions. Let's put it into perspective. If you invested $10,000 in the S&P 500 in 1980 and left it untouched, you'd have over $1 million today. But if you missed just the 10 best days in that entire period, your return would drop by more than half. Those best days, they almost always happen during bear markets when fear is at its peak. So if you're sitting on the sidelines waiting for the perfect entry, you'll likely miss the moment altogether. Actionable advice. Don't try to outsmart the market. Focus on time in the market, not timing the market. Consider dollar cost averaging, invest a fixed amount regularly, rain or shine. Mistake 3, ignoring fundamentals. When prices crash, people forget about fundamentals. They chase rumors, hype, and short-term trades, hoping for quick rebounds, but bear markets expose what's weak and reward what's strong. Let's take 2000's.com crash. Hundreds of tech startups collapsed. But solid companies like Amazon, Microsoft, and Apple eventually dominated because their fundamentals were real. The same logic applies today. Bear markets are filters, they separate hype from value. Actionable advice. Study the companies you own, earnings, cash flow, debt, competitive advantage. Avoid speculative plays unless you can afford to lose that money. Remember, good companies don't stop being good just because prices fall temporarily. Mistake 4, forgetting diversification. The saying goes, don't put all your eggs in one basket, but during bull markets, people forget that rule. They go all in, on tech stocks, or crypto, or real estate, until the music stops. In 2021, investors were overexposed to tech, then 2022 hit, and portfolios dropped 30 to 40% overnight. Diversification doesn't mean spreading your money everywhere, it means balancing risk. Actionable advice. Hold a mix of assets, stocks, bonds, cash, maybe real estate or gold. Diversify across sectors and geographies. Rebalance your portfolio annually, especially after big swings. Mistake 5. Losing the long-term mindset. The final and most dangerous mistake, losing patience. Bear markets test your belief system, they make you question everything, your strategy, your intelligence, your future. But remember, wealth is built through time and consistency, not overnight wins. Mistake 6. Following the crowd. During bear markets, herd mentality takes over. Everyone is watching the same headlines, following the same influencers, and reacting the same way, with fear. You'll hear things like, everyone's selling tech, crypto is dead, it's time to go all cash. But here's the irony. By the time the majority agrees on something, the opportunity has already passed. In 2020, when markets crashed 35% in March, panic spread everywhere, but within just 5 months, markets hit new highs. Those who followed the herd missed one of the fastest recoveries in history. The same thing happened in 2009. Fear dominated headlines, yet that was the best time to buy in a decade. Behavioral economists call this social proof bias. When we're unsure, we look to others for guidance, but in investing, the crowd is often wrong at the extremes. Actionable advice. Don't take financial advice from social media hype or panic. Have a personal investment plan, and stick to it. When everyone is terrified, it's often time to start accumulating quality assets quietly. As Warren Buffett says, the stock market is a device for transferring money from the impatient to the patient. Mistake 7. Ignoring cash and liquidity. When markets are booming, cash seems useless. Why keep money sitting when stocks are soaring? But when the bear hits, cash becomes king. Many investors stay fully invested with no liquidity, then when opportunities appear, they can't buy. Or worse, they're forced to sell their long-term holdings at huge losses just to cover expenses. Liquidity is your safety net and your weapon. During the 2008 crash, investors with cash reserves could scoop up assets at record low prices, real estate, stocks, even businesses, while others were paralyzed by fear. Cash equals optionality. It gives you flexibility, freedom, and the ability to act while others freeze. Let's revisit history. The Great Depression, 1930s, 86% market drop, full recovery in 5 years. The oil crisis, 1970s, recovered in 3 years. The COVID crash, 2020, recovered in just 5 months. The long-term trend of the market has always been up. Actionable advice. Don't let fear override your long-term plan. Use bear markets to buy quality at a discount. Think in decades, not days. Now in the end we will know how to turn a bear market into an opportunity. So, what separates the winners from the losers in a bear market? It's not luck, it's mindset. The smart investor keeps investing regularly, focuses on fundamentals, diversifies wisely, and stays patient. Because every bear market eventually becomes a bull market, and when that happens, the profits flow to those who stayed the course. And remember, bear markets don't destroy wealth, they transfer it from the impatient to the patient. Subscribe for more deep dives into wealth building, investing psychology, and financial freedom.